Welcome back. I'm Peter St. Honest. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. If you've ever felt the federal government should run an airline, now's your chance as Trump floats a $500 million bailout of Spirit Airlines. Spirit as in the butt of every airline joke since I was in college. The deal would leave taxpayers owning up to 90% of Spirit, which is currently worth precisely zero since the company just filed for bankruptcy again. So the background is Spirit was one of the biggest low-cost carriers in America until it was strangled into bankruptcy by Joe Biden's handlers. The tailspin began during COVID when Spirit was losing $500 million a year, so it tried to merge with another low-cost carrier to cut costs and survive. They first announced a merger with Frontier, then JetBlue jumped in with a $4 billion buyout to create a nationwide competitor to the expensive legacy carriers. Biden's antitrust dragged their feet for 2 years while Spirit kept losing hundreds of millions before blocking the merger, issuing Spirit a death sentence. Now, they didn't block it because it would be too big, which is usually how antitrust decides. In fact, JetBlue Spirit would have had just 9% of the market, which is half the size of Southwest and 4 times smaller than Delta. Instead, it was blocked because Spirit was a force of nature reducing ticket prices. Basically, as soon as Spirit started a route, all tickets would drop by roughly 10%. The problem is losing $500 million a year is not sustainable. It was merge or die, and the feds told them to die, killing the golden goose specifically because it was golden. By the time Trump came in 3 years later, JetBlue had moved on, and nobody else wanted Spirit's now $7 billion of debt more than its revenue, all while Spirit was limping along with just 3 weeks' revenue on hand. Then came the Iran war, which sent jet fuel doubling. Jet fuel is about a quarter of airline costs for the big three, but it's almost half for low-cost carriers like Spirit. Moreover, the big three can pass on jet fuel in higher ticket prices since they serve richer customers. Spirit, or JetBlue for that matter, cannot. Customer will not buy the ticket. Jet fuel blew a $400 million hole in Spirit, more than cash on hand. In desperation, 2 weeks ago, they and the entire industry begged the federal government to pause the litany of special taxes on plane tickets. If you've ever looked at your ticket, you've seen these: 7.5% excise tax, per segment fee, 9/11 security fee, airport fee. Altogether, Spirit was paying $400 million in taxes. So hundreds of millions of losses because of their small scale, $400 million in jet fuel, $400 million in tax. This all takes us to last week. Secretary of Transportation Duffy did meet with the low-cost carriers on tax relief, but presumably the cash flow outran the tax talks. By the next day, Trump was floating the bailout. So what's next? One feels for Spirit doing right for customers on price anyway, maybe not food or seats, but done dirty by Washington. But a bailout opens the doors to every other airline facing jet fuel, every trucker facing diesel, freight forwarders, cruise lines, fertilizers, and chemicals which use petroleum. Heck, the Uber guy buys gasoline. Maybe the takeaway is quit killing the golden goose with red tape, management by bureaucrat, and taxes, so you don't need to bail them out. The drunkest sailors in Congress finally got a crack at our new Fed chair, Kevin Warsh, in his first and probably only confirmation hearing. The hearing pretty much did what you expect. Republicans asked about inflation, mission creep, fiscal coordination. Democrats complained Kevin is rich and attacked the same cuts they were demanding before Trump while pretending he said things he didn't say. Warsh himself focused on the Fed's dismal record on inflation and recessions, what it does for a living. The Fed's mission, which is eroded from fighting inflation to tolerating inflation to global warming and diversity. The Fed's willingness to use inflation to finance federal deficits, so-called fiscal dominance, and behind it all the bazooka in the corner, the so-called Fed put, where markets assume if anything goes bad, the Fed will shoot trillions of dollars until everything goes up again. Which is fantastic if you're already rich or if you own a bank, not so fantastic if you have to buy groceries. So the background here is that a Fed chair has two main jobs: bail out banks and create inflation to finance federal deficits and light a tissue fire under the economy that creates jobs today and recessions tomorrow. The bailouts are pretty much institutionalized since Alan Greenspan, bloating Wall Street like a cancer to the point finance is the single biggest industry in America. Indeed, to the point the mere hint of denying bailouts apparently crashes the entire economy. The 2008 crisis started when W gloriously refused bailouts before flipping after Wall Street threw the baby over the ledge. Happily, Warsh has argued for less Fed intervention, the polite term for permanent bailouts. In fact, he wants to slash the Fed's balance sheet, the mountain of assets it bought in past bailouts, which part reverses the bailouts. He's called this Robin Hood monetary policy, as in the Fed helps Main Street at the expense of Wall Street. Still, bank stocks have not budged, suggesting markets don't believe him. They assume if anything goes bad, Warsh will bail them out. Now, this all matters if you're an investor, but most Americans care about inflation, which the Fed creates with two big tools. The direct way is called quantitative easing, QE, where the Fed literally types zeros on a spreadsheet, declares its money, buys everything in sight, creating new dollars. And the traditional indirect way, where the Fed forces interest rates down to make loans cheap. This gooses lending, most of which banks effectively print. It is great for jobs. Each percent of rate cut is worth maybe 1 million jobs, but it's bad for inflation. So Warsh's plan is to use Robinhood to sell the Fed stash, cancel the dollars, chew up enough dollars for more rate cuts, more cheap loans. So Main Street gets cheap loans, Wall Street gets lower asset prices, the inflation cancels out in theory. So what's next? Warsh has a long reputation as a hard money inflation fighter, but so far, he sounds like an easy money guy looking for excuses to cut rates from Robinhood to a newfound concern that AI could launch, quote, structural deflation. Now, this could all be sweet nothings to stay on Trump's good side, or it could be real. Robinhood and AI could deliver an easy money boom, another everything bubble that puts your 401k over $1 million and put starter homes over $1 million. And if it all comes to tears, if Wall Street can't handle the Robinhood squeeze or the AI thing doesn't pan out, we'll be looking at Bidenflation 2.0. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold, paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/Prof St. Ange. That's COINKITE.com/Prof St. Ange. Okay, back to our show. Donald Trump wants the rest of the world to pay for the protection America's been giving them for free for 80 years. Will Europe have to defund their welfare state in favor of a warfare state? Since the Iran war, Trump's been increasingly forthcoming that Europe and Asia need to step up when he needs them after 80 years of America helping them. So far, the Europeans have been digging in. Italian Prime Minister Meloni asserted that, quote, allies are not vassals. UK Prime Minister Keir Starmer, sporting an 18% approval rating just ahead of cholera, says he's, quote, fed up with Trump and wants to make new friends. Amazing how rude the help gets when you stop giving them free beer. Of course, anti-Trump media is framing this as the world turning on America. Bloomberg breathlessly reports on a, quote, slew of world leaders jetting off to Beijing to beg for Chinese money, while Trump, quote, fights with allies. Thing is, those fights are part of a long-standing Trump goal, sometimes termed the Mar-a-Lago Accord, that the U.S. should get something in return for the hundreds of billions we spend defending Europe and Asia. The name echoes the 1980s Plaza Accord, where Reagan told allies if they want access to American markets, they have to stop artificially making their currencies weak, which makes their exports cheap. And in Japan's case, they have to open their domestic markets to U.S. exports. Now, Japan's markets was mostly talk, but the currency worked. In the following 2 years, the value of the dollar dropped by nearly half. The yen went from 250 per dollar to 160, making Japanese exports to the U.S. almost 50% more expensive, and U.S. exports to Japan that much cheaper. The Mar-a-Lago Accords would be this on steroids because Trump is not only using access to American markets, he's explicitly using the military umbrella as a bargaining chip. The idea being we continue protecting Europe, Japan and Korea, Canada, Australia, the Gulf, and in return they stop manipulating their currencies, they give full access to U.S. goods, or they invest trillions to create jobs in America. Plus, they start carrying their weight on military. And my favorite so-called century bonds, where allies convert their interest-paying federal debt, which was borrowed to protect them, into 50 to 100-year debt that pays zero interest. This would save us roughly $200 billion a year of interest, which would cover most of the $300 billion a year we spend defending them. So far, Mar-a-Lago has worked a charm as countries scrambled to dodge tariffs and keep Uncle Sugar on the hook for defense. Dozens of countries have slashed their own tariffs and restrictions on American goods. Allies have promised at least $4 trillion in new investment, which might be worth 4 million jobs, and they're all hiking their own defense spending. NATO members are going from 1.5% of GDP to 2.5% last year, and on their way to 5% by 2035, which would actually have Europe paying more in defense as a percent of GDP than we do. Japan and Korea are close. Japan went from 0.9% pre-Trump to 1.7% on its way to 2%. Korea was already high because of North Korea, but they've hiked from 2.5% to 3%, whilst paying a bigger share of the bases we so generously provide as a tripwire. So what's next? Monetizing America's security umbrella was long overdue, and with the Iran war, it is coming to a head. Some allies will walk away and good riddance. Others will start paying their own bills. Either way, the day is coming when America is no longer the sucker at every table. Last week, Trump's Department of Education announced they'll be cutting off tens of billions in federal loans if colleges cannot show their graduates earn more than high school grads after 4 years, while graduate programs will lose funding if they don't out-earn bachelor's degrees in 4 years. Is it the end of the road for gender studies Ph.D.s on the taxpayer dime? At issue is the $120 billion per year taxpayers give in student loans. Interestingly, 1 in 4 of those loans are in default, which is 4 times worse than credit cards, which they give to anybody, a generation of overeducated deadbeats. Trump's rule would track graduate earnings, and if the degrees fail to raise earnings in 2 out of 3 years, the school loses access to federal loans. This would bankrupt roughly 80% of for-profit universities, according to Brookings, so it will set off a scramble to ditch low-earning majors and steer students into careers that pay more, which should have happened decades ago. So which majors are at risk? The winners are, no surprise, engineering, computer science, math, and physical sciences, which all together make up 1 in 8 degrees, health and nursing, another 1 in 8, and business, finance, and economics, which bring it to roughly 43% that pay the bills. The other half of useless degrees include humanities and so-called soft sciences like sociology and psychology, education, which studies find have zero benefit to quality of teaching, public administration, social services, journalism, creative writing, even gender studies. To illustrate, half of psychology majors are underemployed after graduation. 58% of degrees in leisure and hospitality are underemployed. Turns out you don't need a degree to wait tables. 58% in fine arts, 64% in performing arts. All these would fail the test, as in they can offer the degree, just not on the taxpayer dime. So what's next? An NBC poll last year found 63% of Americans think a college degree isn't worth the cost, while another found the majority of Gen Z does not think college is worth it. They think AI will automate their sheepskin cubicle job. Some students will switch majors, literature to business, climate studies to chemistry, LGBT poetry to nursing, but a lot will skip colleges altogether, since without joke degrees, you actually gotta work for it. This would move us back to the good old days before college exploded, when the vast majority of people got jobs with aptitude tests, which studies have found are 2 to 5 times more effective than GPA. The aptitude tests were gutted by a 1971 Supreme Court decision ruling them racist, but they're quietly coming back. A recent study found 76% of companies now use skill tests or aptitude tests, which they have to do in the face of AI slop applications. So the days are numbered for joke degrees. The day may even come when a college degree means you actually know how to do something useful. A word from our sponsor. Stocks and even gold are all over the place. If you're ready to diversify, Abundant Minds makes Bitcoin mining simple, transparent, and human. You can deduct every penny thanks to Trump's big beautiful bill. It's a 401k for Bitcoin mining. Founded by husband-wife team Bo and Christine Marie Turner after losing $500,000 to broken promises in the mining industry, Abundant Minds was built to protect investors. You own the machines, and they make it turnkey with hosting in their facilities in Oregon. Pricing is clear with one flat monthly fee and no surprises, and they guarantee uptime so you keep earning day in, day out. If you want easy diversification without pressure, learn more at abundantminds.com/Peter to get some of your first Bitcoin mine for free as a gift to my audience. The biggest risk in Bitcoin isn't volatility, it is custody. Because Bitcoin removes the safety net, there is no bank to call, no reset button if something goes wrong. The reality is, most people are not properly set up. They hold Bitcoin but rely on exchanges, incomplete wallet setups, and have no real plan for privacy or inheritance. This is exactly what the Bitcoin way solves. They help you move from exposure to actual ownership, self-custody done right, privacy, inheritance, even running your own node, all set up with you step by step. They never touch your Bitcoin. They're your support team. Go to thebitcoinway.com/Peter to book a free call and go from where you are today to a much stronger setup. Now back to our show. Europe and Asia are facing the, quote, largest energy crisis in history, with over 50 countries now implementing emergency measures as the oil runs out. But not in America, where we drilled baby drilled in the face of a red tape wood chipper by environmentalists who failed to force us to eat the pixie farts. 2 months into the Iran war, the Wall Street Journal reports 50 countries have now implemented emergency measures. Some are rationing fuel, some are giving cash handouts so their citizens don't riot. Some are closing universities, closing factories, mandating work from home, just like COVID. Europe is down 75% of its jet fuel, canceling flights in the all-important tourism season. Australia is down to 30 days of jet fuel before it is cut off like a giant Robinson Crusoe with kangaroos. Ireland's government barely survived nationwide gas protests. Pakistan mandated a 4-day work week and closed all universities to avoid riots. Sri Lanka has declared every Wednesday a national holiday. Congratulations. In India, you cannot cremate with gas. You got to use firewood or break up the furniture to see dear Uncle Sanji to the next world. Egypt ordered an effective nationwide curfew at 9 p.m. Shops and restaurants have to close. They'll turn off the street lights, leaving you to the packs of stray dogs that are Egypt's national animal. In Bangladesh, there have been multiple cases of gas station workers beaten to death over fuel. Note, this is all with a global release of 400 million barrels of strategic oil reserve, replacing about half of the lost supply from Iran. In other words, whatever we're seeing now, it goes Mad Max when the reserves run out. Now, the key for oil isn't the war, it's the Strait of Hormuz. Bill Clinton recreationally bombed Iraq through the 90s, and oil did not care. The Hormuz headlines flit by the hour, but oil futures markets are projecting disrupted supply into 2027 or even 2028, meaning it'll keep getting worse in Europe and Asia as they run out. Meanwhile, in America, we've actually got more oil than we need between what we drill and what we import from neighbors like Canada, Mexico, Colombia, and now Venezuela. In fact, we've got so much oil, armadas of European and Asian tankers are coming to America to sip at our plenty, turning America into what one analyst called, quote, the emergency gas station of the world. So as next, even without shortages, gas prices are still high in America because of that armada of foreign buyers. But the silver lining is America's got thousands of oil wells sitting idle, waiting for higher prices. plus 12 million acres of inactive oil leases that are also waiting for higher prices. These together could crank out another 1 to 2 million barrels a day, making America's inactive wells the 7th biggest oil exporter in the world. It'll take time and it would require Trump/environmental red tape, but if oil does stay above 100, America goes from the world's emergency gas station to the world's everyday gas station, meaning hundreds of thousands of oil jobs, billions in exports. There goes our deficit with Europe and Japan. And that extra million or two in barrels means even lower oil prices once the war is over. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.